Singapore, a tiny nation within Southeast Asia, is renowned for having the best financial, markets, and businesses around the world. From time and time again, Singapore has defied the odds of being such a small nation with only 733 square kilometers to become one of the greatest, if not the greatest, managed economy the world has ever seen. Thousands of entrepreneurs and businessmen alike flock to the Isles of Singapore, as its foreign and local policies are seen as very favorable. Yet, this so-called well-managed economy, as they say, is actually plagued with a huge debt burden. Singapore today has an economy near 400 billion US dollars as denoted by its nominal gross domestic product and as estimated by Singstat, the official government data authority. At the same time, however, it has a government debt that exceeds this economy at over $710 billion, which makes the tiny nation of Asia have a government debt to GDP ratio of about 177%, which, if you have not heard of such a ratio, in simpler terms means that a low debt to GDP would more than likely be better than a higher one, as an individual with low debt means it will have less responsibility when it comes to interest payments or other factors that outweigh his very ability to repay where it loaned the money from. But anyway, going back to our topic, how could Singapore manage such massive debt? This ratio is one of the largest in the entire world. Well, we could point it out this way. There are a number of countries, whether that is today or historically, that have weathered through their impending debt crisis. Yet at the same time, we have also seen numerous countries that have fallen to their demise due to the greed of their people by the need for more capital. Could Singapore be the former or the latter? Further, as Singapore's debt has consistently increased more than its economic output or GDP, it is even estimated that it will keep growing far more in the coming years. This was likely pushed by the previous economic crisis in the past and even the government of Singapore's reluctance as they formally push out numerous packages that would incur more debt. One famous example as we know it is the Significant Infrastructure Government Loan Act, a notable $90 billion Singaporean dollar initiative, which is famous for being the first time in 40 years that the government is actually going to borrow money to finance infrastructure projects. This likewise further pushes Singapore's debt burdens and pushes its capabilities to need more cash-generating schemes to pay off incoming burden interest rates. So this brings us to the very question of this video. How is Singapore managing its debt, and what are its plans going forward? Well, first off, before we answer this question, we must first go back and understand how Singapore's debt came to be. Singapore's public debt has consistently been at record highs each and every year since the 1990s. At that time, it had already incurred over 67% of the debt to GDP ratio, which meant that the country has been stable in its growth and had positioned itself as an economic and financial powerhouse. Over the years, it had extraordinary debt levels even compared to its neighboring countries. Its well-off fiscal policies helped it govern through the impending crisis. As we all know, when the Asian financial crisis hit, the economies of the world had gone from gloom to doom. In 1997, Singapore had a GDP of about $100 billion, yet it fell to only $85 billion by the coming year. This meant that the island nation would have to do something quick and fast to get back on track with its original plans. Hence, it pushed forward Singapore's debt levels over the coming 21st century. In 2003, it recorded a debt-to-GDP level of over 97.6%. This had already made Singapore a nation with one of the highest during the course of the first decade of the 2000s. Yet, at the same time, its economy boomed. It had wavered off. Any impending crisis as its economy, as estimated again by its GDP, had grown significantly further, whereas by 2007 it had grown from $85 billion 9 years ago to over $180 billion. Almost doubling the growth in just less than 10 years. This was fueled by its stance as a further economic and financial hub of Asia. Companies from India, China, across Southeast Asia, and even from the Western nations were flocking to Singapore. They were building out institutions, research centers, and manufacturing facilities, entering Singapore in hopes that they could use the island nation as a base or headquarters in order to enter the gigantic population that Southeast Asia offers. This would go on over the coming coming years, as Singapore's stance as a hub helped it further its economy faster than it could borrow. But relatively in the most recent years, things have looked different. Well, whether that is in Singapore or across the world, Singapore, which had a government debt to GDP of only 112% in 2018, had exploded in just 3 short years to over 117%. This, in today's terms, meant that it is one of the highest indebted countries by relative ratio across the world. Further, as noted earlier, we are still seeing more expansions and more trust in building Singapore as they had done so in previous years, borrowed money and used that money to make Singapore better and greater, positioning the tiny nation as the world's #1 hub for, frankly, everything. Could they, however, continue to do this? Singapore's debt levels over the past 2 decades might have been different as they were able to counteract, but this time, where its debt levels are at record highs and even further macroeconomic factors around the world are at threatening levels which could harm Singapore's economy along with its non-stop search for further spending. Well, we could first look at Singapore's fiscal policies. Its publicized public finance as prepared by the Monetary Authority of Singapore shows that, as of the latest data provided, has gone through an overall deficit, but not by a huge amount. In fact, it was far lower than previously recorded last year in 2020. The government had incurred a fiscal deficit of only about $3.5 billion, lower than its 2020 records at about $36 billion. This means that things are indeed looking good for Singapore over the past 2 years. This deficit, as we know, is important as it could tell us whether Singapore is running at a loss or not. That aside, with a still growing, even though at a small amount, a government deficit, they still continue to ponder on growing the small country. How could they do this? Well, they are still in fact, as they presumably think it is, that they are confident in Singapore's still forever position as a financial hub, meaning its economy, as they too have predicted, will continue to outgrow its debt and further have more cash-generating schemes in order to pay down its coming debt interest rates. Furthermore, Singapore's well-managed government has too much belief in its capabilities not just for its growing economy, but for Singapore as a whole bolstered with cash. They have positions across the country, whether it is their official foreign reserves, which are estimated to be about $314 billion, or even their strong export-oriented economy, which has always helped out its balance of payment records as it shows higher levels of exports concerning its imports. The most recent in 2021 has shown that the country even recorded over $112 billion worth of surplus. In simpler terms, all these, however, just show that the government has every single capability to determine whether its debt dooms, as it has good cash positions and a good balance sheet. Just like any company around the world, as long as it has a big amount of cash in its inventory and has incoming cash to pay off interest rates, it could theoretically borrow as much money as it can as long as it does not exceed what it can earn. One of the most notorious debts that we have yet to mention, however, is Singapore's external debt, which is another huge figure that the country holds. According to the Ministry of Finance, this liability is estimated to be worth over $1.7 trillion, one that far exceeds its government debt, which is also something that, in fact, far exceeds most of all the nations around the world. Could Singapore hold over $1.7 trillion worth of external debt? Well, it's often debated and politicized by such a figure, but most of this actually comes from Singapore's banking sector, which illustrates how big the tiny nation's financial sector is. But can Singapore pay down its debt, whether it is coming from government borrowings or external debt? Well, as argued by numerous economists, it is actually cheaper for Singapore to borrow money. Unlike in 2020, when it had a 10-year bond yield of over 4%, today it sits at around 1 to 1.2%. Its confidence in projecting good returns more than its interest rates is more than likely. The government's sovereign wealth fund has even recorded an annual average of around 5.5% in the last 20 years. This more than likely is another proof that shows how well run the government has become, and thus pushing out such initiatives will more than likely be easy for them to control. Anyway, what do you think?